Hi and good morning everyone. Today we will learn about corporate governance and fraudulent financial reporting. What is corporate governance? Corporate governance is a process and structure used to direct and manage business and affairs of the company towards enhancing business prosperity and corporate accountability, with the ultimate objective of realizing long-term shareholder value and at the same time taking into account the interest of other stakeholders. Corporate governance is also the corporate framework or structure that an entity applies to direct and manage its business and affairs. It is to ensure that those managing the entity properly utilize their time, talents and available resources in the best interest of owner. Next, the objective. The objective of corporate governance is to realizing long-term shareholder value and at the same time taking into account the interest of other stakeholders. For the basic principle, Board of Directors provides leadership and direction to management. Management is accountable to the Board of Directors. Internal and external auditors monitor performance and outcomes. Shareholders have responsibility to make use of their votes. Board is accountable to regulators for conformance with laws and to shareholders, stakeholders for profit and corporate results. There are 8 importances of corporate governance. There are careful management, stability of stock prices, training of directors, involvement stakeholder, improved shareholder communication, talented workforce, checks and balances and goodwill and reputation. In terms of careful management, corporate governance ensures the careful management of an organization, since there are many important decisions which benefit shareholders, directors, social welfare and so on. 2 views regarding the maximization of economic interest, which are Anglo-American and non-Anglo-American. For stability of stock prices, one of the important factors for investors to predict the future performance of an organization. Corporate governance has great impact on the efficiency of stock markets. For training of directors, when the director being selected, they come up with different experiences, expertise and also qualification. It is important to train the directors, so that they adhere to the good corporate governance. For the involvement of stakeholders, they are important for the productivity and efficiency of an organization. They deserve proper attention from the organization. One way to build relationship with the stakeholders is to involve them in the process of business activities. Improved shareholder communication. Shareholder communication refers to the investor's ability to vote their shares. It is the process by which individual investors could communicate with the company's talented workforce. It refers to human capital and is considered as competitive advantage by the organization. Checks and balances. Corporate governance ensures the system of checks and balances in the organization. If the management is involved in taking high-risks project, then all the stakeholders could be informed with the help of corporate governance. Lastly, goodwill and reputation. Many organizations spend huge sums of money to build their brand image for the long-term success in organization. Goodwill and reputation can be improved throughout marketing, corporate social responsibility and strong relationship with the stakeholders.
Audit Committee. This audit committee forms a part of the board committee. It has a direct role to ensure the internal auditors perform work independently and reach the company's goals. Audit Committee shall safeguard the interest of the internal auditors and check whether the internal audit charter, activities and processes are appropriate. They are responsible to assist Board of Directors in discharge their duties relating to the company management, internal control, accounting policies, financial reporting and the communication between the board and the auditors. Audit Committee also should ensure financial statements comply with applicable financial reporting standards. Besides, Audit Committee should strengthen their accountability and corporate governance to provide greater protection for shareholders and investing and depositing public. Role of Audit Committee. The establishment of Audit Committee is to oversee the financial reporting and governance processes and assist the board in discharging their statutory duties and responsibilities. The board is liable on preparing companies' financial statements and audit committee to minimize the involvement of board. There are some roles of audit committee as which are: support the audit function. Audit committee must closely with the audit process to strengthen the auditor's independence. Increase public confidence. It should be done in the credibility and objectivity of financial reporting. The financial statements are free from bias. Monitor company activities and disclosure requirements. The audit committee must be able to access the accounting records and indirectly monitor the company activities. Satisfy the board that adequate attention is being given to risk management. Companies should have prevention and response mechanisms to help them keep risk at acceptable level. Hence, audit committee must determine the systematic methods to evaluate business risks. Lastly is satisfy the board that internal control exists and effective. An internal control system is an important part of the management process. Audit committee should ensure that the control framework is adequate to provide assurance on accomplishment of established objectives, the economical and efficient use of resources, safeguarding of resources and more. Benefits of audit committee. There are some benefits can get from this committee. Firstly is audit committee may improve financial practices and reporting. Audit committee can review, monitor and direct activities and results related to the maintenance of internal controls and preparation of financial reports. It may help to facilitate communication between the management and the auditor as well as the board. Next, this committee can help to prevent fraud. Audit committee should have roles in the prevention and detection of fraud. They should encourage to establish and monitor the management's code of ethic or conduct and monitor special investigations. Third is it can help to develop the internal audit function. With the existence of audit committee, the management's internal audit team can work physically with them to ensure management take appropriate actions to meet its financial and compliance responsibilities. The audit committee is responsible to review the scope, qualifications and activities of the internal audit functions. Fourth is to enhance the external audit function. An audit committee is to oversee and monitor the performance of the external auditors. It will help them to ensure independence level is maintained between external auditor and those involved in managing the management. However, this audit committee can give negative impacts to the management or organization as well and generally. First is interference may occur an executive decision on operational matters. It will tend to undermine the authority of the board. Conflict of mistrust and misunderstanding may arise between the board, management, internal auditors and the external auditors. Audit committee should have clear terms, responsibilities and communication between all parties. It should be made on a timely basis on professional manner. In addition, audit committee itself has no teeth. Audit committee is just a bridge to comply Bursa Malaysia listing requirement. Audit committee must be and be seen to be independent, with authority given to back up their responsibilities. Board must give full support to the committee in terms of financial and administrative resources to carry out their duties. Besides that, the board is distanced from financial matters and the external auditor. This happened when board discharged his duty to audit committee, however, they still responsible on the financial matters of the company. The board should require oral and written reports on all activities of the committee or call the auditors to attend the meetings. Lastly is legal liability of audit committee members. Audit committee cannot relieve the board of its responsibility for the financial reporting process. However, audit committee members may enhance their exposure to possible additional liability.
What is fraud? Fraud defines as an intentional act by one or more individuals among management, those charged with governance, employees or third parties to gain unfair or unlawful advantage which will result injury or damage to others. There are several types of fraud such as bribery, stealing money, financial statement fraud and asset misappropriation. Bribery refers to situation when a person offers, gives or receives of anything of value to influence others. Bribes can take the form of gifts or payments of money in exchange for favorable treatment such as awards or titles. As an example, employees, managers or salespeople of a business may offer money or gifts to a potential client in exchange for business. Stealing money from the company bank account. It usually happens to a small company which there is no segregation of duties. As an example, the person who in charge the bank account are same with the person writes in the checks. Financial statement fraud involving the misrepresenting financial statements by a person doing overstating assets or revenue or understating liabilities and expenses. This types of fraud typically perpetrated by managers who seek to enhance economic appearance of the organizations. The members of the organizations may benefit from the selling the stock, dividends or bonuses. Asset misappropriation involves stealing of cash or assets such as supplies, inventories, equipment and information from the organization. The person who commits the crime will try to conceal the theft by adjusting the records. Next, what is fraud risk assessment? Fraud risk assessment is a tool that assists management and internal auditors to systematically identify where and how fraud may occur and who will be in position to commit fraud. It also concentrates on fraud scheme and whether the controls can be deceived. There are 5 steps of fraud risk assessment. First step, identify relevant fraud risk factor. The process includes review of documentation of previous fraud. Review suspected fraud committed against or on behalf of the organization. Evaluation of related fraud and review the organization's performance measure over the past few years with its competitor. Second step, identify the potential fraud scheme and prioritize them based on risk. Identify fraud schemes through brainstorming, conducting management interviews, using analytical procedure and reviewing prior frauds. Some of factors are to be considered when prioritizing fraud risks are impact of monetary loss of productivity and impact to the organization's reputation. Step 3, maps existing controls to potential fraud schemes and identify gaps. Identifying the preventive and detective controls in place to address each fraud risk and potential fraud. Anti-fraud controls is an important element such as whistleblower protection policy, board oversight and good communication. Step 4, test operating effectiveness of fraud prevention and detection controls. Internal auditing play an important role in assessing the operating effectiveness of internal controls. Example, organization implements security passwords to change every 30 days, but if the password not changed as required, the network system may not block access to the user. From this case, we can conclude the internal controls is present but is not effective. Step 5, document and report of the fraud risk assessment. Key element would likely to be documented include the types of fraud, the business impact of a fraud and the significant fraud occurring. There are 3 common characteristics of fraud that will be explained through fraud triangle. 3 characteristics are pressure, opportunity and rationalization. In order for fraud to be occur, all 3 characteristics must be present. Pressure. Pressure is what causes a person to commit fraud. Most of the time, the pressure occurs because of financial needs or problems such as higher payment for medical bills, higher tax payment. But sometimes, some fraud committed simply out of greed done. Opportunity. Opportunity is the ability to commit fraud. It happens because of weak internal controls, poor management oversight and authority. Opportunities fraud for happen will be increasing if failure to establish adequate procedure to detect fraudulent activity. Rationalization. Most important parts in most frauds. It involves a person reconciling his or her behavior with commonly accepted notions of decency and trust. Example of rationalization to committing fraud are the person who commit fraud to save a family member or loved one, or the person think will be lose everything such as family, house, car, if they don't do the fraud. The end. Thank you.